this is Akshara Menon from PMS Bazaar, welcoming you, and you're watching me on this fundamental interview series. For today's episode, we have Mr. Vivek Sharma, VP and Head of Investments at Estee Advisors. Vivek Sharma brings with him over 18 years of experience in investment management, a graduate from IIT Kharagpur. Vivek specializes in leveraging quantitative models and systematic approaches to portfolio management. At Estee Advisors, he plays a pivotal role in designing and implementing advanced investment strategies, including firm's flagship offering, that is Long Alpha and I Alpha, which has established a strong track record in this Indian capital markets. His expertise spans quantitative analysis, algorithm trading, and delivering superior risk-adjusted returns for clients. Vivek's commitment to innovation and data-driven decision-making is a significantly contributor to this quant investment space. Welcome, sir.
Hi, sure.
So, when I spoke to one of your colleagues to know more about you, what he said was he's a very calm person. He's very calm, composed as such. So, I just want to understand more about you and also about the quant.
Yeah.
The word.
Yeah.
So, and one thing that I learned from him, or one thing I understood about you, is that you love educating people.
Yeah.
In mass numbers.
Right.
So, which you're going to do today with us.
Definitely.
So you're ready to spill out your secrets here,
Sure.
right?
Yeah.
So I can get the unfiltered version here.
Definitely. Let's go for it.
Thank you, sir. The first question that I want to post on you is about quant. Yeah, quant is a buzzword in today's financial landscape.
Yeah.
Which was not the case 10, 12 years back.
Right.
Yeah. So, and ST was one of the pioneers to enter this field much before.
Exactly.
So, what is the difference that you see? 10 to 12 years back, what was the kind of response that you have from investors, and today, where do we stand?
I think it has changed dramatically over last 10 years, the situation. 10 years back, obviously, there were very, very few quant funds, and even they were getting started. Even we were getting started in quant long-only space. We have been doing quant for our HNI customers and other strategies in-house, but to roll out a long-only fund, it was new for us about 10 years back. So when we launched, it was pretty much back tests only that we had to show, right? And even others also, they had some back tests. Everyone was getting started. So there's lots of apprehension in investors' mind at that point of time to where it is today, where we see there are so many quant funds in every space, be it the PMS or AIFs or even mutual funds. You see a lot of mutual fund AMCs now are in line planning to launch different kind of quant funds. So the situation has changed dramatically. 1 year back, investors' interest was also very, very high. Obviously, when I say 1 year back, I mean because over last 1 year, the markets have been flattish, hasn't given any returns. So investors' overall interest has come down a bit. Okay. But that's not specifically speaking about quant. It's overall in markets. It has come down a bit. But overall in quant, I think we don't need to convince anyone right now that quant is one very good way of investing as well. So we see a very good and positive change in the overall investors' mindset over last 10 years.
So which means the investors now are able to understand what it is.
Yes.
So not to go on the basics and saying what is quant.
Yeah.
So not required is what I get from your thing.
Yeah. See, there are a lot of investors who are still entering the markets. And obviously, they don't understand quant and there are still a lot of myths around it. But by and large, the people who have been investing, now they are much more comfortable. And obviously, because like us, there are other quant managers also who have shown good performance over past couple of years. And we have a very good example in Quant Mutual Fund, which has done well overall in terms of different kind of quant funds. It has done pretty well, right? So we don't need to prove to people. But then I don't think that when you say that you don't need to explain to people, because there are still millions of investors who are still just entering the markets. So for them, even equity investing or investing in mutual funds or PMS is very, very new, right?
True.
So I think that education, we still need a lot to do on that front.
Okay. I would say that, quant always correlates with the emotionless investing from fund manager point of view.
Yeah.
But a human being emotionless, it's very difficult.
It's very difficult.
And you can't expect an investor to be emotionless when the portfolio comes down.
Yeah.
Drops by 5%, 10%.
Yeah.
His emotions come out.
Yeah.
So how do you handle that part?
Yeah. It's very difficult in this day and age with this so much of noise. and so much of information that to keep your head straight and focus on what you really want to do with your investments, that's a very tough job to do. As a fund manager, what we try to do is just educate people as to how to manage their investments. And this is not necessarily talking about quant. I think this is talking about your investments in general. If you are able to keep a straight head and keep your emotions aside, I think those are the investors who are able to create wealth over long run. So from our perspective, what we try and do is talk to lot of people, lots of investors, and try and educate them to see how markets evolve, how markets behave over the years, and how your mindset should be while investing. So we do talk a lot to our investors, whether they are our investors or just investor community in general. So I think that is one way that we try and educate people so that they are able to manage their investments well.
So when you talk about investors now, and also you said that markets were flattish for past 1 year. So of course, yes. So do you think, alpha generation, is being narrowed in this current market situation?
See, last 1 year has been tough for everyone, almost everyone. I think quant has particularly struggled a lot, quant space, because a lot of quant managers, they're still new, and they have lost quite a bit in terms of the corrections they have seen. Markets corrected, depending on the index, you talk about 10, 20, 25% in that range. But some of the quant funds had deeper corrections, right? So I think quant managers have learned a lot in this, and also last 1.5 years have kind of separated men from the boys. There's some quant managers who have been able to ride this wave pretty well, not having lost a lot of customers also, and not their drawdowns have been pretty much in control. Frankly, for us also, even though we have underperformed, most of our investors have stuck with us because our corrections haven't been very deep. And that brings us to the mindset that we have in Estee about diversification of overall methodology, diversification of portfolio, all of those things. So having said that, I think from time to time, it's always going to happen that active fund managers would underperform the market.
Okay.
That's a part and parcel of active investing, be it quant or be it the traditional discretionary style of investing. They would always from time to time underperform. And also the second fact is that very few managers, maybe 20, 30, 40% would be able to outperform the market. Rest of the managers would not, over long run, would not be able to outperform the market.
But as you said, that investors are mature enough. So, in terms of PMS, looking into a 1 year returns, do you think it's feasible, or you should look into 5-10 years return?
No, PMS investors definitely, they are much more mature. They have obviously invested in other mutual funds also and other PMSs also. So PMS investors by and large are much more mature, and that's why when I said that we have been fortunate that our performance haven't gone down a lot, and investors by and large have stuck with us. So I find that is, I think, definitely the case, that investors in the PMS are much more mature and they need much lesser hand-holding. But you definitely need to talk to them just to reassure them that everything is fine. But there's a great difference between, say, a PMS investor versus somebody who's just getting started with mutual funds. So, yeah.
But in even active fund management, I mean the traditional discretionary PMS, they follow fundamentals also, they follow quantitative part also.
Yes, now started
now
following.
They started following.
Yeah.
So how does that differing from this quant? Like, of course, quant is fully into model.
Yeah.
But these fund managers are also using fundamental part of it.
Yes.
And also the quant part of it.
Yes.
So how are you seeing them?
So I think some of them might be able to pick up, but it will be really hard for them to learn because this is totally new thing for them, right? So even in my previous job, in Futures First, we used to do discretionary manual trading, and we were pretty good at it. But when we tried to move from our core competence of manual discretionary trading to quant trading, really struggled as a firm because the mindset was definitely not there to succeed as a quant. I think something similar is going to happen in the traditional investing space, that many of them are going to try and do it. Okay. Not everyone is going to be successful, and I feel not everyone should try it also, because they have their core strength in which they have done well, right? So I don't really think that is, for most of them, that's the way to go about it. But there's always going to be a healthy competition between the quants and the traditional discretionary style. Each has its own advantages and disadvantages, and each has its own place in investing. So I think
Everyone will be in the race.
everyone will be in the race, but obviously because quant is just getting started and there are some inherent advantages, obviously I might be biased, but there are some inherent advantages in quant that they are going to take away market share from the traditional style of investing. I think that is definitely going to happen. In the US, you see already most of the money is managed by these systems and computers and quants.
Quant is big in global market actually.
Exactly. So that is the same thing we are going to see, that increasingly market share is going to be captured by the quant.
So quant is going to disrupt this traditional discretionary PMS. That's what I'm going to say.
Definitely, and that's why you see most of the mutual funds also are now planning to launch some of the
Even
other
SIF for that matter.
other schemes, and even SIFs. Most of these are going to be quant, definitely.
So when you say that disruption is something which is common, which will be existing throughout.
Yeah.
So traditional is PMS discretionary has been disrupted by quant. Now, what is the one thing? Can be an AI. Do you think that will disrupt the quant fund strategies today?
Yeah, it could be. I think AI, anyone who is able to use AI well is going to have a clear advantage, be it investing, be it trading, or be it any other field, right? Be it content generation, be it marketing. I think AI has its own place, and anyone who is able to use and take advantage of these new age AI tools is going to have that kind of edge over others who are not using. So we in Estee have already started using it in multiple areas. Obviously in portfolio management it's still very early days, but we are doing quite a few things. One of the idea is which is quite unique, and I like that idea because one of the things that is being talked about quant is also that you don't get to talk to the fund managers.
Yeah.
We don't talk to fund managers, we don't derive anything of value out of those meetings, right? But what now we are planning to do is there are these fund manager interviews and their annual meetings and all of those, and we have recordings of all of that. So by recording, what can you make out? If a CEO or a CFO is giving out some details, can you find out something more apart from the regular details by recording, by their facial expressions, that by the way they are speaking, how confident they are, all of those things I think AI can do very well, and that is something that will come up in the near future.
You think AI will replace the fund manager now? Probably.
See, quant is, we are going in that direction, maybe. I think I was just watching Google CEO's interview just couple of days back, where he was asked this question that what job AI is going to replace. He said that my job could be the easiest one to replace. So you never know the kind of progress we have seen in last couple of years AI make, and we have seen Google just releasing their new set of LLMs in the past couple of weeks. The progress has been phenomenal over last couple of years, right?
Yeah, true. But what investors want to ask a fund manager would be like, what are sectors they're bullish on? What are stocks they're bullish on? But in these questions are never answered from a quant manager. They say they only talk about the model.
Yeah.
Yeah, which may not be the similar for one-to-one client.
Yeah.
So if there's a query from an investor who ask like, what is the sector, or what is, let's step only to sector part. Yeah. What is sector that the Estee is into?
Right.
What would be your answer?
You know my answer, right? We have spoken about this multiple times, that there is no answer. Frankly, see, quant
Probably I can ask you like this way, like what is the model signaling now? Which sector is the model signaling?
So, see, this keeps on changing very fast in quant. If I say these are the sectors, it might 3 months hence it might be totally different. So this keeps on changing. That's the edge that quant has, that we are able to make changes very fast. Now you're talking about what are the sectors that are going to work well. I really don't have an answer to that. But what I know is, and this is from my trading days also, I think quant, where it has done a good job is, there's a process and there's prediction. right? A lot of people, even in trading or even in investing, they feel that prediction is the way to go about it. What's going to happen next? I think some of the best managers, irrespective of whether they are doing quant or not, some of the best managers, they're not into prediction. Even if you hear Warren Buffett's interview, he never tries to predict anything, right? If anyone asks him anything about any prediction at all, he's unable to give out that answer, and he's very clear that that is something that human beings are not very good at, predicting the markets or predicting anything 1, 2, 3 years down the line. But prediction over slightly longer term, you can still make those kind of predictions, right? So it is process over prediction. What we are doing here is following a set process using which over long run we hope to generate sufficient amount of alpha over the index. So I think that process is very important even for investors' point of view. I think that these are two different things. One is process alpha, one is product alpha. So investors are always after product alpha.
Okay.
So this specific product, how much of alpha it can generate, right? That's what they are thinking about. But when you see, they actually, when they invest in any product, the fund returns and the investors' return are not the same, right? They're almost always, fairly large extent, they are different.
Okay.
And investors' returns are almost always lower than the fund returns. Why is that the case? The case is because markets boom, fund returns also boom, and then they come in. So most of the investors we know come in at the top of the market,
yes,
right? And when the returns are not there, then they try and redeem. So effectively what are they doing? They are coming in at top, they're redeeming at bottom. Whereas the fund keeps on doing well, right? So most of the time fund returns are much better than the investor's return. And that's why I say ki, you always think about product alpha, also think about process alpha, which again can add couple of percentage points to your overall portfolio.
It's better to stay invested.
It's better. What's the process? When do you take out money? When do you put in money? All of those, that's the process. Whatever process you are following, think about that as well. So that is equally or even more important than the product alpha. And that's where Quant also comes in, that we are following a process. And using that process, we hope to generate alpha, irrespective of which market does well, irrespective of which sector does well. Now, there's this very famous, I always quote this one when they talk about which sectors will do well. See, some of the sectors like EV or green energy, it's trending these days.
Yeah.
And most likely they'll do very well. But it's not necessary that those companies' returns would be there in terms of their share prices. Why? Because it might be the case that the future growth is already built in. So even though the future growth will be there, but it's already built into the price. So you're already buying at a very, very expensive levels. So these companies might do very well. But as an investor, even if you have invested in them, but you have invested at a significantly higher level, you won't be able to do well.
So where is Quant coming in here?
So see, Quant is coming in about the process. It's about keeping your emotions aside and following a certain set rules, irrespective of the market conditions. Now, as a investor, anyone can do that well, but if a machine is doing, it will be able to obviously do a much better job. So that's where Quant comes in. It's about following a certain set of rules. Quant is nothing but it's a certain set of rules, when to invest, when to get out, all of those rules are there. Those rules might be slightly complex, but it's a set of rules. So that's where Quant comes in, that it has a very, very set process around it, which gives it some advantages over the traditional style of investing.
Yeah, when you talk about the advantages, we need to address the disadvantages as well, right?
Yeah.
So when you talk about momentum investing, that is flowed by the narratives. So like we can be, as a human or as a fund manager, we can stay away from the narratives, but not the system.
Yeah.
So the system will get fluid with the narratives, and that's when the momentum, actually, if you see last 1 year, it wasn't that great for Quant, nor for the momentum investing style.
Exactly, yeah.
They all were underperformed the market. In one question that every investor has is that Nifty is going up, but not my fund.
Yeah.
So why is that? So
See, that can happen with, again, that's nothing to do with quant. That can happen with any active fund, that the markets are going up, but your fund, because it's not really conducive to your style of investing. It could be that the market is going up because all the momentum, because of primarily momentum and momentum stocks and growth stocks are doing, whereas market is not paying heed to the value stocks. So a fund manager who is following a value style of investing is not going to do well in that small period, right? Overall, if he is a good manager, he'll do well, but in certain time periods, it would happen with the momentum funds also, right? So it's nothing to do with quant or anything, but I think a good diversified quant, where it comes in is, it gives you diversification across styles or across different style of investing. So we know momentum is one style of investing, quality is another, value is another, right? So good diversified quant. So quant can be, they're just picking stocks using momentum, right? So their returns would be very high, but when the markets correct, their corrections also are pretty deep. What we follow in Estee is pretty diversified, that we have more than 130 factors.
okay.
Now these are 3-4 popular factors, but we have identified other macroeconomic factors, factors related to specific sectors, specific commodities, all of that factors, right? So we use all of these multiple factors in determining or in constructing our portfolio. So even though, let's say, momentum is not working, some of the other factor would be working at that point of time. So we try and identify using market regimes which specific market regime we are in, right? So in rising markets, momentum, growth, these kind of stocks work very well. Last 1 year, they haven't done very well. So you have got to do some bit of factor timing, wherein you have to build the rules around which factor is likely to do well, and allocate your money only to those kind of factors. So what happens, Akshara, is that all these factors, they don't work all the time. Just like traditional style of investing, they also have their time when they are not able to outperform. Even these factors like momentum, quality, they'll have their periods of underperformance. So what we try and do is, we try and pick which factor is likely to work well in the next couple of months or couple of quarters. So I think there we are able to add quite good amount of value in terms of which factors to pick.
Okay. In terms of factor decay, or let me put it as a model decay, that's one of the biggest disadvantage in quant investing.
Yes.
So what is that? If you could elaborate on it.
I think model decay, what happens is, in your back testing, it has worked very well. One specific signal is there which has given very good results over historically. You put it into production, you start trading or investing using it, and over the period it starts decaying. It's not, the performance is not as expected. Mostly why it happens is because of I think overfitting. So at the time when you are actually trying to define that specific signal and backtest it, there's something known as parameters. You can actually optimize these signals a lot.
Okay.
Right? When you keep optimizing, you have to keep on adding those parameters, right? And because of which it becomes very, very optimized to historical data. But history obviously does not exactly repeat, right? So there will be some changes, but because it is over optimized, it will not really work as expected in the future. So we try and do not too much of curve fitting, and that's something you learn by experience only. So I think if you try to keep your these factors or signals more simple in nature, more intuitive, so that you are able to understand what you are doing, and with less number of parameters, then it really helps you that those signals are much more long lasting than the
others.
The others, yeah.
And also, let's talk. We spoke about factor timing.
Yeah.
Can we talk about factor allocation? Like, for example, in other discretionary PMS, we have, small case would be like 60%, and other large and mid cap would be 40%. In such case, for quant, what is the factor allocation that has been given? Is it like momentum has given a heavy weightage, or value has given high heavy weightage? What
So
kind of a
in terms of
weightage?
performance, historical performance, you are asking,
Yeah,
which has
it
get
can
done
be
well.
anything.
I think one thing is clear. This is across globe, not only in India. That momentum is one factor that does really well. And even in our experience of last 7-8 years, momentum has done the best. The problem with momentum is when it stops working, and if you are still invested in it, it will lead to huge losses also, right? So it becomes very hard over long run. Obviously, if you have to pick one factor, momentum is the factor that will give you the best results. But it's very hard to stay invested in a momentum factor just because it is the most volatile factor also. So that's where the diversification comes in. I was talking about having multiple factors, using multiple factors, and that's what we do. Otherwise, it becomes very hard. Even in last 1 year, I think momentum funds would have easily crashed 30-40% also, right? But if you are diversified, then you are able to ride that wave. Diversified in terms of your factors that you are using.
Okay, but actually my question was like, if you have 130 factors into your portfolio,
Yeah.
into your model, now that all 130 will have the equal allocation.
Exactly. Yeah.
So it is a cyclic turn.
Exactly.
So currently your model
Yeah.
is into heavy weightage on which factor?
So currently it is more around value, it is quality, it is low vol, which is the low volatility stocks. So those kind of conservative factors. So what happens is you tend to, using these factors, you tend to select more of large cap stocks, more of slightly defensive stocks. So it's around conservative. But today, again, markets have broken and made new high. So
New all-time high.
new all-time high. So you never know if it continues for next couple of days and couple of weeks. We again going to allocate to momentum and growth.
Good. And there's one thing that is very common. Apart from the quant word, there's quantum mental word.
Yeah.
It's quite, moving around the market.
Yeah.
So what is the quantum mental part and what is a quant? How does it differ?
See, quantamental, I think quantamental word is coming from quant and fundamentals. So somebody who has been doing fundamentals and who is trying to use quant, that's the word it is coming from. But the way we practice quant is also quantamental, because out of these 130 factors that I spoke about, obviously most of them are technical in nature. About maybe 2/3 of these factors would be technical in nature, but then there are other 1/3 which are fundamental in nature. Right? So we are using, because fundamentals is nothing, it's just their balance sheets. Everything can be actually put down in numbers, right? So anything that can be put down in numbers can be used by quant. So we say it is quant, but we use very high dosage of fundamentals as well in our portfolios. So even though we are purely quant, but we are using a lot of fundamentals. I think quantamental is the term being used by people who were doing only fundamental and now have started picking quant. But any diversified quant fund would definitely be doing fundamentals as well as technicals.
So when you talk about diversification, apart from equity, are you into other multi-asset part of it?
So as of now, no, we are not into it. But yeah, we do have another fund by the name of iAlpha, which has been running now for 17 plus years. It's an arbitrage fund, which does pure arbitrage, and the unique track record that it has never lost money on a monthly basis. Every single month since beginning has been a profitable month. The gross returns have been 12 to 13% annualized over last 16-17 years.
So if you can talk about your process and investment philosophy that Estee follows.
Yeah. See, Estee follows, again, it's about data, but more it is about culture and mindset. That whatever, because at the end of the day, what is happening is these quant strategies are being run by humans.
Yeah.
Right. So if I see, because I was talking about iAlpha, which has never really lost money. So how is that possible? It's possible because we have defined a certain set of processes, certain set of rules that we are going to follow for that specific strategy. And even if I see a very good opportunity, because opportunity comes with this, its risk also.
Yeah.
In our iAlpha strategy, there's some very, very conservative investors who invest in that, who really don't want to take any risk with that part of the money. Right. So I don't want to take any risk and try and generate higher returns on top of it. And that's why we have followed that set of rules, in spite of we have seen much bigger opportunities, but we have said that no, we are not going to go after those kind of opportunities because it comes with own set of risks also. So I think it's about mindset and discipline in ST, that a specific fund, when we decide that these are the things we are going to do, we do that only, and we don't try to deviate away. Having said that, it's not that we don't try and innovate, but we don't, at least risk management, we
That's
don't
the
do.
important part.
Yeah, that's the important part, that risk management, we don't try to do too much of innovation. That is something something we follow at all times, multiple layers of risk management, and that, I think that's been the success behind ST's fund, both long alpha and high alpha. It's not really about how great we did when we were doing well. It's about how we were able to control our losses when we were not able to do well.
I think, getting the drawdowns right.
Yeah.
That is more important in risk management.
Exactly. So in quant, that is slightly easy, or it's very transparent at least. If not easy, it's very transparent. So we have, because each portfolio is constructed of multiple strategies, micro strategies, right? So we have strategy level risks, then we have portfolio level risk, and over top we have the operational risk parameters, that the team who is managing it, the humans who are managing it, if something were to go wrong, what's the protocol, what is it to be done, so that there is no discretion involved, and you are very clear that if this goes wrong, I have to do this, if this goes wrong, I have to do this. So those kind of rules, obviously we have set in the computers also, but those set of rules are there for all the risk managers and the portfolio managers as to what is to be done if something were to go wrong. So that kind of operational mindset, I think that is a key thing which we kind of at times forget, but that I think is the key to our long lasting performance.
Yeah, that touched, of course. And moving on to the next is like, you've been into Quant for so long years, and those words, like from the beginning of the interview, the amount of times that you used the word Quant was more.
Yeah.
So if I could ask you this,
Yeah.
what is the one thing that you want to change in Quant or about Quant?
Okay, so I think one thing that I don't like about quant is the amount of time it takes to prepare the data, because a good set of data, good clean data, which is now available. 10 years back, it was huge amount of effort that we have to put in, but the kind of time and effort it takes to prepare the data for these kind of strategies is still very, very huge. So if I have to change that one thing, it's not very exotic or anything, it's just that if I'm able to create very clean, good quality data, I think that will make our job a lot more easier.
That's one thing that you want to change.
Yeah, definitely.
So how do you see Quant in next 10 years? So you've seen Quant 10 years before. You're seeing Quant now.
Yeah.
So what will be the Quant next 10 years, after 10 years?
I think 10 years, if you see there are a lot of new kind of strategies in AIF space, in PMS space, in SIFs also. So I see a lot people being much more aware about quant, and a much bigger part of overall assets would be definitely under quant, and I think there'll be
Quant will take the majority market share.
Yeah, but the traditional managers would definitely, I think some of them would do a very good job in picking up quant, but then there'll be some good managers who will be doing what they are doing, and they'll do very well over next 10 years. But yeah, I think that is one major shift that we have already spoken about, that a good amount of new strategies are going to come, and especially through SIFs also, and AIFs also allow certain bit of more kind of strategies as compared to PMS. So I think we are going to see lot more amount of kind of strategies being there, and I think SEBI and overall regulators have done a very good job in creating the overall framework around which these different kind of players can launch their products.
Few years back, today we are going to see, Vivek Sharma as a fund manager. But few years back, you're also a restaurant owner. So if you're going to see the unfiltered version of you.
Yeah.
So why was that, and why was that idea?
So this was actually more than few years back. I along with my friends, we opened this South Indian restaurant in Gulaq, because all of us loved food and we loved South Indian food, so we thought we'll give it a try. And it was actually working well, but still, along with a full-time job in trading, it's very difficult to obviously manage a restaurant. Obviously, even if you're not doing trading, even if you're managing a restaurant full-time, it's still a very a difficult business to be in. So as of now, I'm happy doing what I'm doing. But yeah, that was a time where we started this restaurant, shut it down after a year or so.
So any retirement plans on managing a restaurant?
No, definitely not. But I don't have any plans to retire because I love markets too much. So I plan to be associated with the markets for as long as I can.
Okay, that's great. So with that, we've come to the end of this discussion. Let's move to the rapid fire session.
Okay.
So rapid fire, real rapid fire now. So if I have four set of questions.
Okay.
So first would be execution speed or model accuracy.
So for I alpha, it's execution speed, and for long alpha, it's model accuracy.
Okay. So the next is backtesting or live validation.
This is an easy one, live validation, because backtesting, obviously you can do all sorts of backtesting, but until unless you have that live validation in place, nobody is going to trust you. So live validation any day.
So if I have to pick one, if it is consistency or outperformance.
Again, I think an easy one, consistency here.
Okay.
Definitely, because see, I think if there is outperformance without consistency, again, investors, it's no use for investors because they can't really stay invested until unless you have consistency. And I think consistency over long run would lead to outperformance in itself.
Wow. And if I had to ask, food or markets?
Markets any day.
Oh, I think that's the real unfiltered version of how much love that you have on markets. The scene. Thank you, sir. Thank you for accepting this offer and being on the same chair as mine. So thanks a lot.
Thank you, Akshara. It's always good to speak to you.